Forex spreads from 0 pips? That's 1 fee out of 5. Here's the full breakdown.
You opened a Forex broker. The landing page said spreads from 0.0 pips. Sounds cheap. Here's what they don't show you. That number is one cost. There are 5. Real Forex fees stack: spread, commission, swap, currency conversion, and inactivity. On a typical Euro-US dollar trade at a regulated broker, the all-in cost runs between $5 and $14 per standard lot, and the breakdown depends entirely on how you trade. By the end, you'll know what each fee actually is, when it hits, and which account structure fits the size of your account. Because 2 traders running the exact same strategy at the same broker can pay $6,000 apart per year. Same trades, different cost structure. We'll get to why. Let's start with the one you've already seen. The spread is the gap between bid and ask on every quote. Buy 1 standard lot of Euro-US dollar with a 2-pip spread, and you start the trade $20 in the red, before the market moves a tick. 1 pip on a standard lot is roughly $10, linear math. A half-pip spread costs $5. A pip and a half costs $15. Spreads come in 2 flavors. Variable spreads move in real time, tighter during the London-New York overlap, wider in the Asian session or around news. ECN brokers like IC Markets, Pepperstone, and Tickmill all quote variable. Fixed spreads stay constant, wider on average, but they don't blow out during news prints. AvaTrade and Plus500 use those. Now, commission. On a raw spread account, the broker quotes near wholesale prices and charges a separate fee. Industry standard, $3 to $3.50 per side, $6 to $7 round turn per lot. Here's the part the marketing won't tell you. A raw spread account at 0.2 pips plus $7 commission costs about $9 per round turn. A standard commission-free account at 0.9 pips costs also about $9. Same money, different label. The choice isn't about saving cost, it's about workflow. Pick the one whose statement is easier to read. Now the fee that quietly eats swing traders alive: swap. Every position held past 5 p.m. New York time gets charged or credited based on the interest rate differential between the 2 currencies in the pair. Long Euro-US dollar means long euros, short dollars. If dollar rates are higher than euro rates, you pay swap every single night. And brokers don't pass through the wholesale rate. The interbank differential might be 1.5% annualized. The broker quotes the long side at -2.5, the short side at plus 0.5. That 1% gap is broker margin. Even on positive carry trades, you receive less than the real rate. Now here's the part nobody warns you about. Wednesday. Spot Forex settles 2 business days forward, so Wednesday's rollover charges 3 nights of swap, Wednesday plus the weekend, to make Friday's close settle Monday. Triple swap. Carry traders plan around it, beginners get blindsided. Real numbers. A standard lot of Euro-US dollar held 7 nights through 1 Wednesday rollover swings between a $10 credit and a $35 debit, depending on direction and the rate regime. On exotic pairs, long Turkish lira, short Mexican peso, swap dominates every other cost on the trade. If you flatten before 5 p.m. New York every day, this fee doesn't exist for you. If you hold overnight, check the swap schedule before you click buy. Fee number 4 is the one that hides best: currency conversion. Your account base is in US dollars. You trade Euro JPY. Every day, the broker has to convert your yen-denominated P&L back into dollars at their mid-rate plus a markup, typically 0.5% to 2%. On a $100 gain, a 1% conversion is $1. Sounds tiny. It isn't. Run that across hundreds of trades a month on non-dollar pairs, and the conversion charge often beats the headline spread cost. It just doesn't show up on the same line of the statement. The workaround? Multi-currency accounts. Interactive brokers, Saxo, and IG Premium let you hold balances in euros, yen, pounds simultaneously. Trade yen pairs against a yen balance, and the daily conversion never happens. If you trade non-US dollar pairs in any size, this single feature pays for itself. Now, a quick note on the costs that aren't even in the fee schedule.
Slippage on market orders. The price you saw isn't always the price you got. In normal liquidity, the difference is a fraction of a pip. During a Fed announcement or a non-farm payroll print, slippage can be 3, 5, 10 pips. Not in the schedule, real money. Spread blowouts and news windows are the same story. A broker quoting Euro-US dollar at 0.3 pips on average can show 15 pips for 30 seconds at 8:30 a.m. Eastern. If your stop sits inside that range, you got taken out at a price the schedule said couldn't happen. These aren't deceptive, they're documented somewhere in the broker's terms, but they're not on the marketing page, and they accumulate for traders who don't actively manage them. If you trade around news, knowing this is the cost, skip the windows or widen your stops.
And now the strangest fee of all, the fee for not trading. Most regulated brokers charge a monthly inactivity fee after your account goes dormant. Plus500 charges $10 a month after just 3 months of inactivity. eToro and CMC Markets, $10 after 12 months. FXCM, $15. Oanda, $10. The brokers with zero inactivity fee ever? IC Markets, Pepperstone, Interactive Brokers. Why this matters? The fee comes out of your remaining balance, directly. Fund an account with $500, walk away for 2 years, and inactivity fees alone can zero you out before you ever log back in. If you're testing a broker and decide it's not for you, withdraw the balance. Don't leave a small amount sitting there. It will quietly disappear. Okay, now the part I promised. Why 2 traders running the same strategy can pay $6,000 apart per year. It's not the strategy, it's the account size matched to the fee structure. Small accounts under $2,000 get crushed by fixed commission. Pay $7 on a 0.01 lot trade worth $1,000 of notional, and the fee is the equivalent of a 700 pip spread on that position. Economically dead on arrival. For small accounts, commission-free standard structures win. Wider spread, no fixed commission per lot, micro-lot trades stay viable. Bigger accounts, over 10,000, flip the math. The raw-spread-ecn structure pulls ahead. The fixed $7 commission becomes a smaller share of each trade's P&L, and the tighter spread compounds favorably across volume. Here's the worked example. 80 round-turn Euro-US dollar lots a month. That's a part-time day trader. Raw-spread-ecn, about $680 a month. Commission-free standard, $720. Retail commission-free, $960. Fixed spread, $1,200. That's a $500 gap between the cheapest and most expensive structures every month. $6,000 a year. Same trades, same broker quality, same strategy. So here's what to do. Add up the fees you'll actually pay. Spread plus commission per trade. Swap if you hold overnight. Conversion if your pairs cross your account currency. Inactivity if you fund and forget. Compare it against your monthly P&L target. If fees eat more than 10% of your expected gross, you're either at the wrong broker or trading the wrong size for that broker. Fix that before you do anything else.
5 fees, not 1. Match your structure to your size. Full breakdown linked in the description.